I don't know why more people don't do this, but after you've built a relationship with a financial advisor and you've known them and worked with them for many years, ask them what do they own. Ask them what's in their portfolio, what products they own. Oftentimes, financial advisors are happy to share that information, and we see a lot of products cross our desk on a daily basis, and we know what's good, what's great, and what's not so good. And if we went out of our way to spend our hard-earned money on a product, you must know that it's exceptional for some reason. Now, that doesn't mean I advise my clients to do everything that I do. Why some of the strategies I deploy may not be appropriate for them because I'm decades younger, or I may be in a different income bracket, or they may be married with 4 kids. It's not blanket advice, but you better believe if I bought a product, there is something exceptional about that product, because in my career, I've seen hundreds, if not thousands of products cross my desk. And if I'm shelling out my hard-earned money for something, it must be pretty good. Today, I'm talking about life insurance and retirement policies and why life insurance and retirement can work hand in hand. Stay with me. So the first thing I want to talk about is something you probably have never heard of, and it's something that is selectively very beneficial. This is something you would have to work with a financial advisor and an accountant to learn more about, but it's something called a LIRP, a life insurance retirement policy. A life insurance retirement policy is basically when you are able to use a life insurance policy to fuel your retirement. So the way that it works is that I would underwrite a life insurance policy for a client. I don't care about the death benefit. In fact, I want the smallest death benefit I can possibly get. Why is that? Because I'm not buying this for the death benefit. I'm buying this for another feature. So I get this person a, let's say, $50,000 life insurance policy. It's a permanent life insurance policy that they can own for the rest of their lives. And we are going to overfund the heck out of this thing. Think about someone who's a very high income earner who is already maxing out their 401k, IRAs, any other retirement plan, and is in a stable, high earning career, like let's say a surgeon. They're earning $750,000. They have too much money and they don't know exactly what to do with it. We create a LIRP. They're going to put away $5,000 every single month for the next 10 or 20 years. Okay. It's a variable universal life insurance product. So basically, they're variable products in that LIRP. It's going to grow over time. When they retire, they are going to be able to take a loan against the cash value of that product, and they never have to pay that loan back. Now, you have to be very, very careful with LIRPs, because if you mess it up, you create a huge problem for a client. There's something called the MAC, Modified Endowment Contract, which I'm not going to go into, where if you get it wrong, if you fund it the incorrect way, or if you deconstruct the contract to loan the client money the wrong way, the IRS will get involved. That's why I say you really do need a financial advisor and an accountant on board with this. But when it works beautifully. It's not for the average American, because the average American isn't even maxing out their 401k or their IRA. It really is for special circumstances. Like I said, a surgeon who is earning $750,000 a year knows he or she will be in that profession for 20, 30 years and earning, goo gobs of money, and just needs a place to deploy that money for the future goal of retirement, and is planning to take a future loan against that value in that life insurance policy. It also comes in handy. Think about this. A surgeon, for example, a very successful surgeon gets into an accident, and their hand is caught in the deployment of the airbag. So they have nerve damage in both hands, and they're just not going to be a world-class surgeon anymore. And they go on disability. Very generous disability policy, because they were high income earners. And as a financial advisor, I advised them to get disability policies. And essentially, they're in their mid-40s. This disability policy is going to cover them into their 60s. They are earning a good 5-figure amount every single month. They may not go back to work simply because the disability policy is able to cover everything. The one caveat with that is it's killing their Social Security. They have no earned income for the year. Disability is not earned income. It's also killing their retirement savings. All retirement savings must come from earned income. They don't have any earned income. They're not married. So what we would do in a situation like that is create a LIRP. and life insurance policy, overfund the heck out of it. And then when that person turns 65 and is eligible to get off of disability and on Social Security, we can start taking loans from the LIRP and use that for retirement purposes. That's an example that actually happened to one of my clients, and it was a really creative way of continuing a person's journey in saving for retirement, even though it was a very little likelihood that they would ever go back to work because of their disability level and because of the income that they were earning in disability. If you want to learn more about a LIRP, I really strongly suggest you talk to an accountant or financial advisor. It's a very delicate dance to get a LIRP right, but it's very powerful for people who are high income earners and rich and who want to defer that income into the future. Whole life insurance policy. And I will say this, and many other financial advisors have said this. You can kind of research this yourself on YouTube and on Google. I don't like whole life insurance policies. I've never provided a whole life insurance policy to a client. I've inherited whole life insurance policies, and I've never seen a whole life insurance policy work out long term in a client's favor. I think there are better financial instruments to meet the client's needs, and whole life insurance policy just really, in my professional opinion, doesn't make sense for almost anyone. So just to give you a quick overview of what a whole life insurance policy is, it is a life insurance policy that lasts your entire life. They can be quite expensive, and basically part of the money is going to cover the death benefit. Part of the money is going into an account where it's saved in a fixed income instrument. At certain points in the future, you can take out a loan against the value of the whole life insurance policies. The problem with these loans is that it is often a loan at interest, meaning you are paying interest on the loan. Very few people will actually pay back a loan they take out of their whole life insurance policy. And what happens after that? Like, let's say you have a $50,000 whole life insurance policy. You've built up $50,000 of cash value. 10 years in the future, you take out a $25,000 loan. It is a loan at interest. And so the interest cuts in to the cash value and the dividends. And over time, the loan basically corrodes the cash value and the death benefit and the dividends. And over time, it can actually corrode the death benefit. I have had clients who owned whole life insurance policies who died and their beneficiaries got absolutely nothing. Why? Because the person took out a loan 20 years ago, never paid it back, and the amount that they borrowed, the interest on it, basically ate up the cash value, ate up the dividends, and finally ate up the death benefit, so that when they died, the beneficiaries received nothing. Again, I've never seen a whole life insurance policy quite work out the way the person has intended. I have taken whole life insurance policies and feng shuied them into other types of policies that were more beneficial to a client. So personally, I do not own a whole life insurance policy. I will never own a whole life insurance policy. I do not provide them to my clients. If I see a client, I inherit a whole life insurance policy from a client, I often look for ways that we can feng shui them out of a whole life insurance policy. Do I universally not recommend them? I think you need to do your own research, and you need to talk to a financial advisor, a certified financial planner, to make your own determination about whole life insurance policies. But I can tell you from a financial advisor's perspective, I've never seen them where they've worked out in a client's favor long term. They always turn on a client in a very unexpected way and end up cannibalizing the cash value, eating up eating up the dividends, and oftentimes taking out the death benefit too. Okay, so let's get back to talking about retirement. There is another product, a long-term care life insurance product. Now, long-term care, I'm a big advocate of long-term care, or at least thinking very carefully ahead about long-term care, because if you live beyond the age of 60, odds are you are going to have a long-term care event in your life, and few Americans are really prepared for that eventuality. Long-term care is very expensive. Long-term care can be very difficult to get. I have provided long-term care policies to clients, and I have been let down by long-term care policies in big ways. I was expecting long-term care policies to activate in certain situations, and we put in all the paperwork, we sent all the medical and all the documentation that this person really needed their long-term care policy, and the long-term care policy underwriter refused. I've seen long-term care policy underwriters make it really difficult to submit the receipts for reimbursement. I've spent hours on the phone with long-term care providers, basically bawling them out, pressing them to really provide benefits to my clients. I've been let down a lot by long-term care policies. When it came time for me to think about my own long-term care policies, there are two very important things about myself. I may retire abroad. There's a good chance that I'm going to spend a significant amount of time abroad. A lot of long-term care policies do not cover you abroad. You must be here in the US. And B, I've dealt with receipts for reimbursement, and I totally understand what a beast of a situation it can create. Someone's got to track all that. Someone has to submit receipts. Someone has to submit the paperwork. And if an individual doesn't have a child or a fiduciary or someone who can step up and do all that work, it just doesn't get done. So when I was looking for life insurance for myself, I was looking for something that would cover me abroad. And I was looking for a product that did not have receipts for reimbursement, would just cut me a check. Life insurance policies. There are life insurance policies that there have a long-term care rider. And the long-term care rider activates when you don't meet 2 of the 6 indicators for living. And I won't go into that. You can research what they are. But essentially, it pays out cash based on the death benefit every single month until that policy expires. Now, in 2020, one of these policies crossed my desk. And there's something called an A-type policy and a B-type policy. A-type policy is just death benefit. Let's say you have a policy with a $250,000 death benefit. If you die tomorrow, it's $250,000 death benefit. If you go into a long-term care event, it's only $250,000 long-term care benefit. If you die when you were 80, it is a $250,000 death benefit. There's something called a B-type policies. Now, B-type policies, they're incredibly expensive and incredibly rare. So when one crosses my desk, I'm looking at it, I'm clocking it. I want to see what this B-type policy is about. B-type policy, the death benefit from the day that you sign it is $250,000, but you also have a cash value account. So I'm paying for death benefit of $250,000, but I'm also putting aside money in the cash account. So God forbid, when I have a long-term care event, let's say 40 years from now, I'll have the $250,000 death benefit and hopefully at least another $500,000 or significantly more sitting in the cash values. I will be able to access that $500,000 death benefit if I don't meet 2 of the 6 indicators for a living, and the policy must pay out over 25 months. Or if I don't have a long-term care event in this lifetime and I just die, my beneficiaries receive the full $500,000. Now, I paid attention to this when this crossed my desk. I knew that this was going to be available for a hot minute. And once the insurance companies really ran the numbers on this, they were no longer going to offer this product. So, I ran, not walked, to this insurance company and signed myself up for that life insurance long-term care product. And I got it. And right as rain, 6 months later, after I was approved, they pulled it from the market. But of course, they still have to honor my long-term care policy. Now, this is something that works brilliantly for me because I got it when I was relatively young. So the premiums weren't like otherworldly expensive. They're expensive, but they're not otherworldly expensive. I know that I plan on retirement abroad. This can cover me abroad. And I don't have to worry about receipts for reimbursement. It's the perfect product for someone in that situation, but the product is virtually non-existent. And that's what I say when you're talking to your financial advisor, and after you've gotten to know them for a while, get to know what we own. Because, if you tell me, hey, that product sounds amazing, if something like this crosses your desk again, can you give me a call and push me to go ahead and apply for this? Because this is something that really would make sense for myself for long-term care. But it's one of those things where life insurance meets retirement and blends together seamlessly, but it's only rarely available. You probably see that product maybe once every 5 to 10 years. And it's only available for 6 months, because once the actuaries take a second look at that product, they're going to realize that they may not be it may not be in their best interest to sell that product to people. Term policies, term life insurance policies, and retirement. So typically people, if you were to die in that 10, 20, or 30-year period of time, it would provide a cash sum payout to your spouse or beneficiary, and it would all be tax-free. Typically people have term life insurance policies in their younger years, but by the time they are in retirement, their 20 or 30 years has gone by and they don't renew because it's otherworldly expensive at that point to renew. Typically, when I am providing life insurance, term life insurance policy information, we're doing a calculation to see when their youngest child will be grown, right? To determine when and how a person needs a term life insurance policy. Does a person need a term life insurance and policy in retirement? Depends on the person. I would talk to a financial advisor to make the final determination, but usually not. Usually you can let go of that term life insurance policy at retirement. But if a person had their children older, I just always make sure that their oldest child will be grown by time that policy terminates. So there you have it. The fusion of life insurance and retirement. There is quite a bit of overlap there, and there is some interesting overlap. Tell me what you think. Tell me what you like. Tell me what you don't like. And if you found this information useful, please like, share, and subscribe.